Welcome to this explainer. Look, we are skipping the usual preamble today because honestly, there is an incredibly urgent market shift staring us right in the face. The rules of the crypto game are changing, and they're changing fast. If you aren't prepared, you could quite literally find your assets locked out of the next major era of digital finance. Okay, let's dive into this. I know it sounds like an exaggeration, right? But this is a very real, very immediate danger. Across Europe, platforms that fail to comply with massive new regulatory frameworks are going to be forced to abruptly halt their services. Meaning, you might wake up one morning, grab your phone, and find your ability to trade, deposit, or withdraw completely frozen, just like that. Section 1, the MiCA deadline is officially here. You need to circle this date. Highlight it, set a reminder on your calendar, July 1st, 2026. This is exactly when the Markets in Crypto Assets Regulation, or MiCA, goes into full enforcement in the European Union. Think of MiCA as the ultimate club bouncer for crypto platforms. Basically, if your platform isn't on the VIP compliant list with a very specific MiCA license, they are operating illegally, and they are getting kicked out. As our sources highlight perfectly, the Wild West era is officially closing for good. And here is the trap that so many investors are falling into right now. That famous glowing brand name on your phone screen, it means absolutely nothing. Seriously, just because an exchange is a global titan doesn't actually protect you. What matters is the specific legal entity buried way down in the fine print of your user agreement. You could legally be tied to an offshore entity right now without even realizing it. And this brilliantly illustrates exactly what we're talking about. Think of your capital exposure right now like a traffic stoplight. Look at Bybit EU GmbH. They're in the green. They've already secured Austrian Financial Market Authority, or FMA, approval. So if your account is specifically with that entity, you're cleared for operations. Then you have KuCoin sitting in the yellow zone. They have a conditional license, but they're facing an FMA operational warning with conditions to meet. And then there's Binance, flashing red with critical risk due to major uncertainty around their Greek license application. That means a very high risk of sudden service interruptions. Section 2. Securing your crypto assets. So what do? Well, you absolutely cannot trust the marketing emails. You have to go straight to the source. Step 1, go download the interim ESMA MiCA register. Step 2, check your exchange's terms of service and find your exact legal entity. And step 3, match that entity to the active approved list. Make sure your required services are actually approved. Guys, you absolutely cannot skip these verification steps. It's crucial. But hey, it's not just the exchanges at risk here. It's the assets themselves. MiCA specifically targets what they call asset reference tokens, which is essentially just their bureaucratic classification for stablecoins. This puts massive heavyweights like USDT at severe risk of sudden delistings or restricted trading pairs on EU platforms. You need to audit your stablecoin exposure like yesterday. If your platform loses compliance, you face the hidden risks of trapped liquidity, meaning you literally can't move your funds. And if you're trading on margin, there's the very real threat of forced leverage closures when market liquidity completely vanishes. And take a look at this number right here, 0. That is the exact amount of statutory deposit insurance you have for any crypto sitting on an exchange right now. 0. Crypto on an exchange is not a bank deposit. Sure, MiCA brings oversight, but it absolutely does not guarantee a bailout. Because of this, it is absolutely crucial right now to move your long-term holdings into self-custody on a hardware wallet. Only keep your active trading capital on centralized exchanges. Section 3. The Institutional Infrastructure Era. Now, we're shifting from this immediate regulatory panic into a massive macroeconomic paradigm shift. Tokenization has completely moved from a fun novelty gimmick to a very serious legal debate. The old question was simply, can assets be put on-chain? But the new question, it's what actual rights are on-chain? What does the token holder actually own? Is it exposure, redemption rights, collateral rights, or is it literally just a digital wrapper? The answer to that question is driving unbelievable amounts of capital, $51 billion. That is the reported market cap for tokenized real-world assets, or RWAs. We're seeing massive traditional players entering the space right now. You've got Bailey Gifford and BNY launching tokenized fixed income funds. Even longtime crypto critic Nouriel Roubini is entering the tokenization conversation with a planned product backed by an ETF. Think about that. Let's move to this next part and see how this all builds. Because we are seeing rapid-fire proof points everywhere of digital assets becoming mainstream infrastructure. Japan just launched a trust bank yen stablecoin via SBI. The Bank of England is actively moving toward issuer-level guardrails for sterling stablecoins. Over in the US, SIBO is launching regulated binary options through SIBO Predicts, and Kalshi is literally suing the state of Illinois to establish a federal footing for prediction markets. Stablecoins and prediction markets are fully entering the regulated arena. Meanwhile, digital asset treasuries are facing a pretty harsh capital discipline test. Global Bitcoin exchange-traded product holdings have dropped 8% from their peak. Major corporate holders like MicroStrategy are actually being advised by analysts to pause their Bitcoin buying. Why? To rebuild cash reserves to handle dividend obligations and preferred stock coverage. Yet, completely independent of all that price action, network utility is absolutely booming. Bitcoin's Runes protocol, a new standard for tokens on the network, is driving over 820,000 daily transactions. It's a true stress test for the entire market. Section 4. Merging Tech, DeFi, and Culture. Now, take a look at this massive momentum signal. Pudgy Penguins, a digital IP born entirely from meme culture, are now hitting physical retail store shelves. I mean, this is a brilliant example of bridging on-chain liquidity and community directly with tangible consumer goods. It really shows how the space is maturing way beyond just internet speculation and evolving into genuine real-world brand building. And on the financial side, we're witnessing an incredible merge between TradFi and DeFi. Traditional Wall Street assets, specifically tokenized Tesla and Nvidia stocks, are actually being used right now as collateral on decentralized lending platforms like Venus on the BNB chain. Traditional equities are directly powering decentralized finance. It's creating entirely new cash flow and lending opportunities that literally did not exist a few years ago. But as AI enters this economy, security has to completely level up. Alchemy's agent card now enables AI agents to transact via Visa. That's huge, but automation needs security, right? So OPSEC has launched an industry cybersecurity coalition, and AI is now actively neutralizing predatory MEV bots, those automated programs that skim profits from regular traders. This is a pretty stark contrast to the severe accountability issues we're still seeing in speculative meme coin platforms like Pump Fun. Section 5. The new tokenomics model. So the crucial point is how you structure trust from day one. Take a look at the KINGFINITY or KFX token distribution model here. They have 35% allocated to the treasury and 30% to public distribution. Only 10% is going to the team and founders. This equitable, community-first model is exactly the kind of framework that builds genuine trust with both strict regulators and incoming institutional capital. Slated for launch on October 7, 2026, with a 1 billion token supply built on the ultra-fast Solana network, KFX really represents a specific blueprint. This is exactly how trustworthy projects are positioning themselves to not just survive, but to actually thrive after these regulatory gray areas are completely cleared out. As we build this new trust layer in public, we really have to ask ourselves some deep structural questions. As highlighted in the KINGFINITY Insights newsletter, if AI agents are becoming real economic actors spending money on chain, who is legally responsible when they make the wrong move, right? How do we actually build automated trust that has real enforceable accountability? I'll leave you with this final thought as you audit your own exposure today. When the golden gates of MiCA finally slam shut on the unregulated Wild West, will your portfolio be trapped on the outside, or will you be holding the keys to the new compliant frontier? Take the time today to check those legal entities, secure your assets, and master this new era. Thanks for exploring this complex transition with me today.